All right, let's get it started here. So first up, we're going to start with a pop quiz, and the pop quiz is asking, what does the mortgage term non-QM actually mean? So A, non-quick money, B, non-qualified magicians, C, non-stop question management, or D, non-qualified mortgages. So these are the options. Hopefully you selected non-qualified mortgages. That's actually what we're going to be talking about today is two specific types of non-qualified mortgages. And what does that actually mean? We'll get to that. But we're going to talk today about DSCR loans and bank statement types of loans. This presentation is technically for real estate agents who are in the state of Florida and licensed and operate in the state of Florida. I'm a loan officer. I'm a mortgage broker with Collab Lending. My name is Nate Stewart, licensed in Florida as well as Puerto Rico. But in this presentation is specifically about loan programs that we have available in Florida, as well as some other markets. But I'm going to stay focused on how things operate in Florida, right? So thank you very much for those of you that are going to be joining us today. Real quick about me, I'm a father and a husband. I split my time between Florida and Puerto Rico, kind of going back and forth. I'm a mortgage broker and a YouTuber. I have a YouTube channel called, well, I'll put the link at the end. But I used to be in a past life a former educator. And so I've been trying to generate some more information and content, trying to teach about mortgages and how those things work. So that's what we're doing today. And then my life goal is success through service. So I was once told that if you just focus on serving others, then the money and everything else will come. And so hopefully, well, so far that seems to be the case. So trying to live in service. And I consider myself a values-driven problem solver. So one of the things I like about working on the loan side of things is it's a lot of problem solving. It's a lot of some math involved, lots of talking with people and helping figure out how to get to the finish line. So let's talk about what we're going to see today. So we're going to talk about what the heck are non-QM loans and why should a real estate agent care. We'll do a deep dive into bank statement loans and why and which kinds of clients that might be a good fit for. We're also going to talk about debt service coverage ratio loans, which are often called DSCR, and we're going to talk about current rates and industry news, and we'll leave some time at the end for questions and answers, right? So jumping right in, what really are non-qualified mortgages? So if you think about like your 30-year conventional fixed rate types of mortgage where you're going to be basically that after it closes, that loan is going to get sold to Fannie Mae and Freddie Mac so that the lender gets the money back on the back end and then continues making new loans. That's what helps keep the whole industry churning. Those are loans that, aside from those are not what I'm talking about here. Those are what we call qualified mortgages. Those are conventional loans. They fit in this nice, neat little box, right? The credit, income, assets, and property all fit in the nice, neat box so that they can package it up and sell it off to Fannie Mae and Freddie Mac. In contrast, non-QM loans are those that don't fit into this nice, neat little box, specifically the income source used to repay that loan, right? So non-QM loans are just that. They're loans that don't fit the usual income requirements for the borrower. And for that reason, we're not going to ask for W-2s or pay stubs. We're not going to ask typically for tax return documents, all those normal types of documents that we ask for a conforming type loan that fits in this nice neat box. This is going to be outside the box, right? Other types of income. And so we're going to look at things like bank statement, like using bank statements to show income. We're going to use rental property income. We can use large assets, right? If they have like a whole bunch of money and then they're going to liquidate pieces of it, or a profit and loss letter. These are the types of non-qualified mortgage programs that are out there. And so hopefully having some of this information in your back pocket as a real estate agent, that'll help you serve more clients, help people get to the finish line, grow your business, and all those good things. So those things I should mention, like I said there on the screen briefly, these have only been really around since like 2010. It was like this was a response to the financial meltdown of 07, 08, and around those years that the Dodd-Frank Consumer Protection Act of 2010 identified that these are some other ways. Because before that, they had people just like stated income loans, where you just like ask the borrower, how much money do you make? They said a number and you just took it at face value. So that's no longer the case. So here's what we got. Bank statement loans. Let's take a look at how those things work. So obviously, bank statement loans, it's very much like what it sounds. These are loans that use the borrower's bank statements to verify the income and that's instead of tax documents. In fact, if I'm helping a borrower get a bank statement loan and I send the lender their tax statements, I've just completely disqualified them for being able to get a bank statement loan. The lenders do not want to see tax return documents. And this is because for self-employed folks specifically, bank statement loans can be a really good option, right? And here's why. Is because obviously many people who are self-employed, and this could be freelancers, entrepreneurs, contractors, real estate agents as well. But typically what folks do is, for their business expenses, they write a lot of business expenses off and consequently, like they pay for lots of things out of the company's money, if you will, and they write those things off as expenses. Might be for meals, it might be for these other things. And there's nothing fishy about that. That's just a tax strategy. And that's what, business owners are allowed to do. They're allowed to write off expenses so long as it is related to operating the business. But then typically they will show when a self-employed person comes to file their taxes, they're going to be showing less income on their tax returns. And it's usually not as much income as like the deposits that's hitting their bank statement. So we have this discrepancy. So when self-employed folks try to qualify for conventional loans, that use the tax in returns and use the W-2s and those kinds of things, it's going to show a lot less income usually because of this tax strategy. They're usually writing stuff off. And so bank statement loans, since we're not going to worry and we're not going to look at the tax information, we're just going to look at how much of the self-employment, activity deposits are showing up on those returns, right? So we focus just on those types of documents rather than the tax info. And so we can use personal bank statements, we can use business bank statements, or some lenders let us use a mixture of both. But the important thing to think about is that typically we will need at least 12 consecutive bank statements, or even better, if they can provide 24 consecutive bank statements. And because 24 statements is going to show more continuity, more consistency of that income over a longer period of time, that's going to result in a better rate, right? And if you put yourself in the lender's shoes, that makes sense, right? Because the rate and the terms are all related to how much risk the lender sees. And because they're not asking for tax documents, right? If you can show 2 years worth of deposits hitting your bank statement showing that, yep, you're generating this income, that's going to be less risk to the lender. They're going to see that as, oh, okay, the income's more consistent. We can give them a lower rate. We can give them better terms. But 12 months is also feasible, right? So long as the business has been operating and they've been generating an income that they can show on bank statements 12 consecutive months in a row, they should be good to go. There would very likely be a loan program we could get for that borrower. And these FICO scores, we can go all the way down to about 620. Some lenders will let us do that. Obviously, there'd be a hit on the rate for that. And then there are loan programs with bank statements that go for only 10% down as well as 20% down. So those are the typical terms. We're going to see slightly higher requirements for down payments for bank statement loans, precisely because the lender, since they're not looking at tax information, there's a little bit of additional risk in there. And so to mitigate that, they're going to require a bit more of a down payment. So that's kind of in general how the bank statement loans work. And I think for real estate agents, I think that the most important thing to know that y'all can know is that it's not only like, the tax document types of loan programs out there. If you meet somebody, if a client comes up to you and meets you at one of your listings, and they're talking about, you get to talking and they're self-employed, but they might, they sound like they might be worried about being able to qualify. That, even if they're self-employed, even if they're not reporting a whole bunch of income because they're using that strategy of writing off a lot of business expenses, bank statement loan programs might be a really good fit for that. All right. Let's move over and talk about this other type of non-QM mortgage called debt service coverage ratio, DSCR. So these are that name sounds quite complicated and technical. Really, these are one of the simplest types of loans for folks. And I want to be clear that these are typically for investors only. This cannot really be used for people looking to buy their primary home. And I'll get to why in just a second. But for this type of loan, for DSCR loans, the borrower does not need to have any employment. They literally don't have to have a job. They don't need to have any type of income of their own. They don't have to have a credit score. They don't even have to be a resident of the United States, right? They can have, so long as they have a visa with permission to enter the U.S., they could be eligible for one of these types of loans. So there's very, very different requirements, very low in terms of requirements. So, but the income that's going to get used for this, because for mortgage lenders, really all they care about is that loan getting repaid. So they want to know, how are you going to generate the funds to repay this loan every month? And for this type of loan, it uses the subject property's rental income, right? So again, they only care about the cash flow of the subject property, the
Wow.
property that that borrower is going to buy, right? So that's what they're looking to purchase. And so we can use long-term rental income or short-term rental income, either one. There's no debt to income ratio to calculate because we're not, while we look at a credit report for the borrower, we're not actually going to care about how much monthly debt they have, because the idea is that, well, that's their responsibility to pay from their whatever income source they may have. But to repay the loan, it's going to use the rental income that's definitely going to be getting generated after the closing. So we don't even have to calculate a debt to income ratio for these types of loans. It is designated for real estate investors, not for home buyers, because it's a higher risk. And if the borrower defaults, like they're not able to generate the rental income that they were hoping for, these types of lenders, they don't want to also have to go through a whole eviction process and when they do a foreclosure. So to avoid that additional thing, they only offer these types of loans to real estate investors. And so what we look at, specifically the ratio we care about, is the net operating income, right? So we're going to take what the expected income is for the property, and we're going to divide that by the debt obligation, or we're going to divide that by what the monthly payment is, the full principal, interest, taxes, and insurance monthly payment, and if there's any HOA, we're going to divide it by that. And so long as the ratio is one or better, meaning that it's generating more income than is needed for the monthly payment, we have a loan, right? We have a loan. And so the higher that ratio can be, like the higher over 1.0 that ratio will be, meaning it's going to generate a lot more income than there is to cover the monthly payment, then the better the rate will look, and oftentimes the better the terms and everything will look. So that's how DSCR works. It's also, we can go down to about 620. There's lenders that'll go to 620, but because it's a higher risk type of loan, typically it's going to be 20% down minimum, and also typically requires 6 to 12 months in reserves. Okay. There are DSCR programs for experienced landlords. Those would have a bit better interest rates, because those folks have already shown that they've managed properties. They know how to to maintain them and keep them cash flowing. So those folks would have access to slightly better rates. And then there are DSCR loans for first time investors as well, but they're going to see a slight increase on the rate because it's a little bit higher risk from the lender's perspective. This is great for borrowers who already own a whole bunch of other rental properties. If you have a client who's looking for rental properties and they already have a bunch of rental properties on their own personal name and in their own personal credit, sometimes the amount of documents that we have to track down just to get them approved is nuts. And so DSCR vastly reduces what we have to look for. It's a lot more streamlined in that respect. So this could be a good option for those folks that are, already have several other rental properties going. And most lenders will allow these types of loans to close and be vested in an LLC. So it's another way that they can help protect themselves if they have a whole bunch of rental properties. All right. So those are the looks. Again, I told you we're gonna get through these things relatively quickly. Not, I know that folks are busy. We're not trying to take up and eat up a whole bunch of your time. But here's a look at where rates are at today on the 20th of November, 2024. All of these rates are related to the same scenario pretty much. So if we look at a $475,000 purchase for a single family home in Florida, for the primary residence of the borrower, with FICO of 760 and no discount points at all. So it's looking like my rates didn't populate, but if from memory, the conventional at 5% down, I believe that was at 6.375. FHA with 3.5% down. That rate today, I saw that was at 5.375. So that was considerably lower. FHA going 3.5% down. VA with 0% down. Looks like that was at 5.75, was the lowest rate that I saw from our lending partners today. Again, that's zero down and with no discount points included. Bank statement loan at 20% down. The lowest rate I saw for that was at 7 1/8, so 7.125%. So yeah, we're going to see a little bit higher rates for bank statement loans, and that's just because it's a little bit higher risk, right? We're not looking at tax documents, we're not looking at those traditional types of income, so we're going to see a little bit higher rates for those programs. And DSCR looks like the lowest rate that I see today with 20% down was at 7.625 for that specific type of program. So those are where rates are kind of at. It gives you a little bit of a purview there. Oh, here we go. There they populated. But let's see, did I have it right? Yeah. So 6.49, 5.625, 7 3/4 there with VA 7.125, 7.625. Cool. So there you have it. And again, we're going to see that the rates for non-QM are going to be a little bit higher because it's a little bit riskier for the lender. So we see that there's a bump on those rates there. But thank you all so much for having joined today. The next webinar is going to be on not next Wednesday, because that's the day before Thanksgiving. We're going to push it. We're going to go every other week with these webinars. So hopefully you can join us on Wednesday, the 4th of December, also at 12 noon Eastern Standard Time. Here's a QR code if you want to scan it and save my contact info. There's my contact info down there in case you have any questions you want to reach out to me. Feel free to call me, text me, send me an email. There's my YouTube channel link like the link to find me on YouTube as well. But anyway, super grateful for those of you that connected in today, and I will look forward to hopefully having another webinar. Again, just like mini webinars, just trying to get some provide some value for real estate agents out there in Florida, so that you guys can continue to improve your knowledge base, grow the business, and help more clients and help yourselves as well. All right. Well, thank you very much for having joined today, and I hope to see you next time.